In this video, we'll discuss how taxes and fees can impact your returns and how to minimize their effects to keep more of what you earn. Taxes and fees may seem small, but over time, they can significantly eat into your investment gains and reduce the benefits of compound growth. Let's start with taxes. Capital gains taxes are applied when you sell an asset for a profit. There are two types: short-term capital gains, which apply if you've held the asset for less than a year, and long-term capital gains, which apply if you've held it for longer than a year. Long-term gains are usually taxed at a lower rate. So holding your investments for the long term is not only good for compounding, but also for minimizing taxes. If you're investing in tax-advantaged accounts, like a 401k or an IRA, you can defer or even eliminate taxes on your returns, allowing your money to compound tax-free. Now let's talk about fees. Investment fees, like management fees or trading commissions, might seem small, but they can add up over time. A higher fee can take a bigger bite out of your returns, especially with compounding. When choosing funds or investments, look for low-cost options like index funds or ETFs, which tend to have lower fees. Even a difference of 1% in fees can significantly affect your returns over a few decades. By being mindful of taxes and fees, you can help ensure that more of your money stays invested and continues to compound over time. In the next video, we'll discuss the importance of consistency and patience in investing, and how they are key to maximizing compound growth. Compound growth is one of the most powerful forces in finance, and it's the key to building wealth over time. In this series, we'll explore how reinvesting your returns can help you achieve long-term financial success. Compound growth might sound complicated at first, but it's really a simple concept with extraordinary potential. Let's start with the basics. When you invest your money, you can earn returns. These returns could come in the form of dividends, interest, or the growth in the value of the stock or asset you've invested in. Now, here's where the magic happens. Instead of taking those returns out, you reinvest them, meaning your returns start generating their own returns. And over time, this compounding effect accelerates the growth of your wealth. Let's take a basic example. Imagine you invest $1,000 at an interest rate of 5% per year. At the end of the first year, you'll have $1,050. That's your original $1,000 plus $50 in interest. But in the second year, instead of earning interest on just your $1,000, you'll earn interest on the full $1,050. That means at the end of year 2, your investment will grow to $1,102.50. The difference might seem small at first, but the longer you keep reinvesting, the bigger that difference becomes. Think of compound growth as a snowball rolling down a hill. At first, it's small and slow, but as it keeps rolling, it picks up more snow, getting bigger and faster as it goes. The same principle applies to your investments. Each year, your wealth can grow exponentially as your returns start earning more returns. This process is the reason why long-term investing is so effective. It's not just about making quick profits, but about letting time work in your favor. The longer your money stays invested, the more powerful compound growth becomes. In this series, we'll dive into how you can take full advantage of compound growth by reinvesting your returns and making smart financial decisions. We'll break down how it works with stocks, bonds, and other investments, and show you why consistency and patience are key to unlocking the true potential of your money. So, let's get started on this journey and explore how you can use the power of compound growth to secure your financial future. Now that we've covered the basics of compound growth, let's talk about one of its most important components: reinvesting. Reinvesting is simple, but it's incredibly powerful when it comes to growing your wealth over time. When you invest in stocks, bonds, or other assets, you often receive returns in the form of dividends, interest, or capital gains. Now, instead of taking that cash and spending it, reinvesting means you put it back into your investment. Essentially, you're allowing your returns to generate even more returns. Let's break it down with an example. Say you've invested in a stock that pays you a $100 dividend at the end of the year. You could take that $100 and spend it, or you could reinvest it by buying more shares of that stock. If you reinvest, that additional $100 will now also start earning returns. Over time, this reinvestment accelerates your wealth building process. There are some great tools that make reinvesting easy. For example, many companies offer what's called a dividend reinvestment plan, or DRIP. With DRIPs, dividends are automatically reinvested into more shares of the company, often without any fees. It's a way to make sure your money is always working for you, without needing to manually reinvest every time. Here's why reinvesting is so crucial. Every time you reinvest your returns, you're allowing your investment to grow exponentially over time. Instead of just earning on your initial investment, you're also earning on the growth of your returns. This is the essence of compound growth in action. But reinvesting isn't just limited to dividends. You can also reinvest the capital gains from selling an asset or the interest from a bond. The key idea is that by putting your returns back into your investments, you're allowing your portfolio to grow faster than it would if you took the money out. So, while it might be tempting to spend your returns when they come in, reinvesting them can have a much greater impact in the long run. Whether you're investing in individual stocks, mutual funds, or even bonds, the principle remains the same. Reinvest your returns and let compound growth do the heavy lifting. In the next video, we'll look more closely at how compound growth actually works in practice. And you'll see why the combination of reinvesting and compound growth can be a game changer for your financial future. Time is one of the most critical elements in unlocking the full potential of compound growth. The longer you leave your money invested, the more powerful compounding becomes. This is why you often hear financial experts say that the earlier you start investing, the better. Let's take a look at why time matters so much. Imagine two people. One starts investing $200 per month at age 25, while the other waits until they're 35 to start investing the same amount. Both of them invest until they're 65. Even though the second person invested for 30 years, the first person, who started 10 years earlier, will end up with significantly more money at the end. Here's the math. Assuming an average annual return of 7%, the person who started at 25 would have around $524,000 by age 65. The person who waited until 35 would only have around $244,000. That's less than half the amount, even though they only invested for 10 fewer years. This happens because compound growth accelerates over time. The early years of investing might not seem as impressive. Your money grows, but not by much. But as you continue reinvesting your returns, the growth starts to compound on itself, and over time, the numbers get bigger and bigger. Time isn't just important for growing your money. It also helps you ride out the ups and downs of the market. Investing over a longer period gives you more time to recover from short-term market fluctuations. Over the decades, markets tend to rise, even though there will always be periods of volatility. The key is to stay invested and give your money time to grow. Starting early is one of the biggest advantages you can give yourself. But even if you haven't started investing yet, don't worry, it's never too late to begin. Every extra year you can give your investments to grow will make a difference. The most important thing is to start and let time work its magic. In the next video, we'll dive into how compound growth works in different types of investments like stocks and bonds, and how to balance risk while still benefiting from the power of. Now that we've covered the basics of compound growth, let's compare it to simple growth, which many people might be more familiar with. Both types of growth will increase your investment, but compound growth offers a much bigger advantage over time. Let's start by defining the two. Simple growth means you're earning a fixed return only on your original investment. It's like earning a flat amount of interest each year, based on the principal, but the amount you earn doesn't change. Compound growth, on the other hand, is where things really start to get interesting. With compounding, you're earning not just on your original investment, but also on the returns that your investment generates. Over time, this creates an exponential effect. Let's look at an example to see the difference in action. Imagine you invest $10,000. With simple growth, if you earn 5% per year, you'll make $500 each year. So after 5 years, you'll have earned $2,500 in total interest, and your total balance will be $12,500. The returns are steady but flat. Now let's compare that to compound growth. With compound interest, that same 5% return doesn't just apply to your original $10,000, but also to the interest you've earned along the way. After 5 years, your total would be about $12,763. Not a huge difference at first, but the longer you keep your money invested, the wider the gap becomes. After 10 years, with simple growth, you'd have $15,000, but with compound growth, you'd have over $16,288. After 20 years, with simple growth, your total would be $20,000, but with compound growth, you'd have about $26,532. The difference gets bigger and bigger the longer your money stays invested. This is why compound growth is considered so powerful. It accelerates your wealth building over time in a way that simple growth can't. In the next video, we'll explore the role of reinvesting dividends and how this can supercharge your compound growth, especially in dividend-paying stocks. Now that we've covered the basics of compound growth and simple growth, let's take a deeper look at how reinvesting dividends can supercharge your compound growth. Dividends are payments made by companies to their shareholders, usually from their profits. Instead of taking the cash and spending it, reinvesting these dividends into more shares of the same company can significantly accelerate your wealth building. This is called a dividend reinvestment plan, or DRIP, and it's one of the simplest ways to grow your investment over time. Let's look at an example. Imagine you own stock in a company that pays you $200 in dividends at the end of the year. Instead of pocketing that $200, you reinvest it to buy more shares of that company. Now, those new shares will also start earning dividends. So next year, you're not just getting paid for your original investment, but also on the additional shares you bought with the dividends. Over time, this reinvestment creates a snowball effect, where your dividends generate more dividends and your wealth grows at a faster pace. What's great about dividend reinvestment is that it works automatically in many cases. Once you enroll in a DRIP, your dividends are automatically used to buy more shares without you having to do a thing. You're essentially compounding your returns without any extra effort. This strategy is particularly powerful in dividend-paying stocks that are stable and have a history of increasing their dividend payouts over time. For example, if you had invested in a company like Coca-Cola or Johnson & Johnson decades ago and reinvested your dividends, your returns would have multiplied many times over. Dividend reinvestment, combined with the power of compound growth, is one of the most effective ways to build long-term wealth. In the next video, we'll talk about how compound growth works with different types of investments, like stocks versus bonds, and how to use both in your portfolio to maximize returns while managing risk. Now that we've covered the power of reinvesting dividends, let's talk about how compound growth works with different types of investments, such as stocks and bonds. Stocks and bonds are two of the most common investments, but they offer different levels of risk and returns. Stocks generally provide higher returns over the long term, but they can be more volatile in the short term. Bonds, on the other hand, are more stable but offer lower returns. When it comes to compound growth, stocks typically offer more potential because their returns are higher. Over time, stock investments can grow exponentially, especially when you reinvest your dividends. For example, if you invest in a stock that grows at an average rate of 7% per year, the compounding effect can significantly increase your wealth over time. However, bonds are still an important part of a portfolio, especially if you're looking to reduce risk. Bonds provide more predictable returns and act as a stabilizer during periods of stock market volatility. They might not grow as fast as stocks, but they play a critical role in managing risk and preserving capital. A balanced portfolio with both stocks and bonds allows you to take advantage of compound growth while also managing risk. As you get closer to retirement, it's common to shift more of your investments into bonds to protect your wealth while still allowing for some growth. The key takeaway here is that compound growth works across both asset types, but understanding how to balance risk and reward is crucial. In the next video, we'll discuss how to avoid common mistakes that interrupt the compound growth process, such as withdrawing funds early or reacting emotionally to market swings. In this video, let's talk about some of the common mistakes that can interrupt the compound growth process and how to avoid them. One of the biggest mistakes is withdrawing your money too early. When you pull money out of your investments before letting compound growth do its work, you're cutting short the time your returns have to build on themselves. Patience is key when it comes to investing. Allow your money to stay invested for the long term to reap the full benefits of compound. Another mistake is reacting emotionally to market downturns. It's natural to feel nervous when you see your investments lose value, but selling during a dip can lock in your losses. Historically, markets tend to recover over time. The best strategy is often to stay invested, ride out the volatility, and keep focusing on the long term. Dollar cost averaging, investing a set amount at regular intervals, can help you avoid the trap of trying to time the market. Consistent investing over time is one of the most effective ways to harness compound growth. The final mistake is not reinvesting your returns. Whether it's dividends from stocks or interest from bonds, reinvesting ensures that your returns generate more returns, accelerating your wealth building process. By avoiding these common pitfalls, you can maximize the power of compound growth and stay on track to meet your financial goals. In the next video, we'll talk about how taxes and fees can impact your returns and how to minimize their effects so you can keep more of what you Welcome to our series on reinvesting returns and the power of compound growth. Over the next few videos, we'll explore one of the most powerful forces in building long-term wealth: compound growth. So, what exactly is compound growth? In simple terms, it's the process of earning returns on both your original investment and the returns you've already earned. By reinvesting your profits, you create a snowball effect that accelerates the growth of your wealth over time. Throughout this series, we'll dive deep into key topics like: what is reinvesting? We'll show you how reinvesting your dividends and profits can supercharge your wealth building. The magic of time. Time is your best friend when it comes to investing. The earlier you start, the more powerful compound growth becomes. Stocks versus bonds. We'll compare the compounding potential of these two common investments and how to balance risk and reward. Avoiding investment mistakes. Learn how to avoid the common pitfalls that can interrupt compound growth, like reacting emotionally to market swings or pulling your money out too early. How taxes and fees impact your returns. Small costs like fees and taxes can take a big bite out of your returns. We'll share tips to minimize their impact. Consistency and patience. The key to unlocking the full potential of compound growth is regular investing and staying patient over the long term. By the end of this series, you'll have a clear understanding of how to make compound growth work for you and how simple strategies like reinvesting and staying invested can secure your financial future. Get ready to unlock the full potential of your investments and let compound growth do the heavy lifting. Let's get started.